Good morning and welcome to the Money Control live stream. You're watching Markets with Santo and CJ. Well, it's a muted start for us on the last sheet this morning. If you look at the Nifty futures on the SGX, they're indicating a flat to moderately negative start on the back of a similar sort of cues emerging from Wall Street last night, where although the Dow closed in the green zone, the S&P and Nasdaq were quite soft. Fed Chief Jerome Powell again reiterated that they want to fight inflation at this point of time, even though there was some expectation that, recently, some slowdown in economic activity in the US could change the tune of the Fed. But clearly at this point of time, that is not forthcoming for the bulls in the market. The key thing today, of course, will be the F&O expiry. The June derivative series will be expiring later today. And, of course, the biggest question in everybody's mind is where the Nifty would probably end this series. Now, we have seen a good recovery, Santo. I mean, from the lows of about 15,200 that we reached, we have recovered almost 700, 800 points from there. But at this point of time, it seems like we could end up having a very muted expiry. Although I still firmly believe that there is a good chance that we might see some sort of short covering towards the latter half of the session. Also, let's not forget that today is the last day of the quarter. So generally, at the end of the quarter, you end up seeing a lot of rebalancing from, not only domestic mutual funds, but from foreign mutual funds and, passive funds as well. So there could be some buying coming in later in the day. And I feel that, the crucial bit for the Nifty would be to cross that 15,900 handle or the 910 handle, which is also the 20-day DMA for the Nifty 50 index. And I think bulls' confidence will start, revving up from there on if we can do it. But on the downside, if we go below the 15,670 handle, then probably we could see the bears again taking charge of the narrative.
Well, CJ, still it's a tug of war happening at the moment, and neither side is getting, unlike on the political side where now finally there's been a clear victor. I think at least in the markets we are not seeing that yet. Neither the bulls nor the bears.
I think the bulls need an Eknath Shinde at this point of time.
No, neither of them at this point seem to have the confidence to to press for the initiative. We have the earnings season coming up. Now, CJ, the only good thing right now in this otherwise lackluster market is that probably you're now seeing some kind of slowing by FIIs. They've been selling very heavily. That has come off a little bit. But again, on the flip side, look at it. Domestic institutions too have started to go a little slow.
Exactly my point. Yeah. Now, I think overall it seems like the market participation itself is going down. I think market investors
that will make the market very volatile. Now we the kind of pressure that you're seeing on the rupee, one would have thought that maybe FIs will step up the sales. Again, that is not happening. You could see some kind of a tactical shift right now. Probably sectors like pharma, IT, which benefit from a weak rupee. Probably there could be some bit of tactical shift. But yet, most investors would rather wait for the initial set of earning numbers, which will start rolling out the week after next, before firming up some kind of a view. And the general consensus at this point, CJ, is that there are likely to be more downgrades than upgrades.
Yeah, I mean, the June quarter earnings, clearly a lot of analysts believe would be possibly a washout, although year-on-year numbers will definitely look good because, of course, the last quarter, this quarter was the second wave. Then we had the brutal second wave of the COVID, and clearly there were lockdowns. And therefore, while the optically year-on-year numbers might look good, sequentially, I think there would be concerns that possibly you could see some slowdown not only on the top line but the margin. Of course, that is the bigger issue. But I feel at this point on Santo, rupee is the market that is clearly stealing the limelight from equities and bond. I think everybody's eyes are totally transfixed on what is happening in the rupee market, because let's not forget that the 80 handle is very close now on the rupee.
Well, let's dive into the stocks on our watch list this morning, starting with ONGC and Oil India. CJ, we were having this argument earlier this week also. I think among all the sectors at this point in time, crude, the ones which actually benefit from rising crude prices, seem to be the best poised, and I would say that Oil India and ONGC are now in a sweet spot, especially after the government yesterday, the cabinet cleared the decision to allow crude producers to sell it to any refiners of their own choice. Now, so far there were limitations on whom the crude producers could sell their output to, which meant that often they were not in a very good bargaining position to extract the best of prices. That will change now. We already saw the market positively reacting to this announcement, both Oil India and ONGC stocks did rally. Now, these stocks have been relatively holding steady in an otherwise volatile market, and I think it's still, given the overall PSU overhang, and these stocks are always vulnerable to sudden policy shifts. That's one reason you've not seen sustained upside. But at least in the short term, CJ, I see these stocks doing well.
Yes, Santo, no doubt there. I mean, I'm totally with you on the fact that I have also been, talking about how ONGC could be one of the stocks of the year, although so far this year it has not performed that great on concerns, of course, the PSU tag, the windfall, rumors of a windfall tax, all of those things have been there, and let's see, hopefully the market will move on from that, those concerns and focus on the fundamentals, because the fundamentals are pretty sweet. Another stock where the fundamentals are looking quite sweet, but the stock is not performing is Tata Motors. Now, the domestic commercial vehicles segment as well as the passenger car segment has been an outperformer for Tata Motors over the past 1.5 years, and all the expectation is that that run will continue going ahead. We are already looking at CV demand picking up. On the electric side of the business also, Tata Motors has been winning a lot of tenders from government for electric buses and whatnot. Their own EV cars have become quite successful so far, and they already have a lot of launches planned over the next 2 to 3 years. So clearly, the India side of the business has been doing quite well, but concerns have always centered around JLR or Jaguar Land Rover. Now, there I think, Santo, while I take the point that volumes probably will remain muted because, of course, they're facing a very acute chip shortage, the cash flow generation from JLR has still been quite strong. Apart from that, because JLR has been able to generate that cash, I think Tata Motors will also remain on its trajectory to become net debt positive going ahead. They have indicated that they intend to be net debt positive in another 1.5 to 2 years. So clearly that target looks quite achievable, and I think market should largely focus on that part, because as and when the chip shortage eases, because Tata Motors is already taking steps towards that. They recently yesterday only announced a partnership with the Japanese firm to initiate or get into the chip making business through another Tata Group company. So clearly they are taking efforts to sort that issue out, and in the meantime they are focusing more on high margin products. JLR is focusing more on high margin products. I think that bodes well for the future.
Well, I was just looking at the longer term chart of Tata Motors again. There's a lot of chatter around Tata Motors. Mainly that was because the stock had crashed quite dramatically during, of course, most stocks did crash, but in the case of Tata Motors, it was really dramatic. It fell to around 65 odd. And from there was this comeback journey. People were talking about the passenger vehicle story there, how it's managed to really, from almost being a no-hopper, how it's managed to consolidate its position in the passenger car segment. Now that the CV segment is also beginning to slowly look up. Yet, can't help feeling that this over a longer term, longer term investors in Tata Motors have never been rewarded. Just look at the 5-year graph, the stock falls, and also now this passenger car story is not really new, Nexon was launched back in 2019, 2018, and we've had now good 4 years of that story, right? JLR 2 is not a new story really, right? It's also been there for quite some time now. And yet the market, seems to have decided that beyond a certain point, it doesn't make sense investing in the stock, which is why you're always seeing the stock run into a resistance around 450 levels. And those who have held on to the stock for almost 5 years now, they have very little reason to cheer. Of course, people who had bought during the COVID sell-off, which saw the stock fall to about 60, they have a lot to cheer.
Absolutely.
But it doesn't look like things are going to get any better soon. And also consider the fact that both US and China at this point in time are looking at a severe slowdown, and these are the major markets for JLR. So even if you have the chip shortage being solved, I think so the JLR part of the story, which has been holding up Tata Motors for quite some time now, that engine is not going to fire.
Well, I think, Santo, China probably could be the outlier here, because if they emerge out of the COVID lockdown as and when they decide, they see the sun finally and decide that COVID is probably behind them, I think China could be one driver for JLR going ahead, even if the US and the EU market might be slowing down.
Well, Persistent System is the other stock on our watch list today. Now, a huge correction in the stock price. Overall, this year has been quite tough on IT stocks in general, particularly the second line stocks. Persistent too has taken quite a beating there. The stock is down close to about 30% from the record highs seen in April. Now, according to Money Control Pro, probably these, it's time to start looking at, some of the stocks where valuations have become reasonable in the IT sector after this huge sell-off. Persistent System is one of the stock. Good strong performance there in top line growth. 4 quarters in a row, the company has grown by close to 7%, and while part of it has been helped by the acquisitions that the company had made, even excluding those acquisitions, the number, if you include the acquisition, then the number goes up to 9%. But even if you keep aside the acquisitions, there still it's about a 7% growth quarter on quarter for 4 quarters in a row. Also, the company has managed to maintain margins in what was maintain and in fact improve on its margins close to about 180 bips in FY22, and it's confident of maintaining margins this year also. The company has indicated that its deal pipeline remains quite strong. It was quite good in FY22 as well, close to about $361 million, of which 54% was through new orders, and the overall order booking was about 46% higher year on year. So this is one stock. It's a little on the expensive side when you compare it to frontline IT stocks, and yet this is a stock you should definitely keep an eye out for.
Well, Santo, first of all, I didn't expect you to go bullish on an IT stock, and that, leave it on an IT stock, that to a mid-cap IT stock.
It's a tactical thing,
with
the rupee coming falling
on the west today. I think I'll have to ask my producer to check that for me, but you said it rightly. The stock is still quite expensive. Despite a 30% correction, it's still trading at about more than 30 times 1 year forward earnings, which is much higher than say peers like Infosys and TCS, which probably are maybe growing 300 or 400 basis points lower than what Persistent is indicating at. So I don't think I want to pay that much of a premium for a mid-cap stock where volatility is going to be much higher going ahead. Apart from that, if you're expecting a revival in the IT space, you will first see that in the frontline names or the large cap names. I really doubt that will happen in the mid cap space so soon. Maybe 6 months down the line, mid caps also catch up with the large cap names. But at this point of time, if you really want to go buy IT, you go buy the top 5 names, not anything beyond that. And lastly, the margin issue. Margin issue, I don't think is behind us at this point of time. Yes, they could get some benefits from the depreciation in the rupee. The rupee has depreciated more than 6% so far this year, so that should aid margins. But I don't think it will be able to totally offset the issues that they are facing towards staffing issues. You have talent crunch there in the IT industry, and also Persistent is trying to make a lot of new investments into newer products, so that itself should also be an overhang on the margin front. One stock that is looking quite good, although yesterday's trade it sank almost 7%, is MTAR Tech. Now, I firmly believe that this is a long-term growth story in the Indian defense industry as well. And for investors who are looking for the long term, this could be the best point of time to look into a stock like MTAR. Yes, the promoters did sell a part of their stake in yesterday's trade. They sold about 600,000 shares. But Santo, look at the people who have been buying. You have a HDFC mutual fund which has added on to all the existing stake that they have of over more than 1% in the company. So that really shows that there is sign of confidence from a fund manager like HDFC. Apart from that, on the fundamental side, MTAR has guided for about 50 to 60% growth in top line in FY23, along with an improvement in margin. Yes, the margin improvement is not significant, about 80 to 90 basis points, but clearly the management is very confident of growth. And if you're getting 50 to 60% growth in a market like this, I think it's just a no-brainer to, after the sort of correction that the stock has seen. Apart from that, IIFL Security itself expects about 57% annualized growth or per annum growth in net profit over the next 2 years for the stock, driven largely by the strong India business. So clearly a lot of tailwinds for the company in the fundamental side of the business, and in valuation also have corrected quite significantly.
Couple of points here, the promoters selling at a point when the stock is already under pressure, that doesn't seem to send out a very positive sign, which is why maybe you saw the market reacting the way it did yesterday, 7% drop in the stock price. Besides that, I think there are some other concerns as well. The receivables have gone up quite considerably to about 154 days now. Inventory levels have also gone up. Besides, there's been a sharp deterioration in the working capital cycle as well. So these factors put together I think there's every reason for market to feel concerned at this point. Well, the
Let's
market
take
has
a
just
check on the market, Santo. And it's a largely flat opening as indicated. The Nifty is down or now it's turned into the green. You have Sensex also turning into the green just now. The mid-cap space is doing better. The Nifty mid-cap index is higher by 0.1%. But Santo, the advance rate declines are actually in the favor of the bulls. I mean, you have almost 1,000 stocks rising on the NSE with about 538 stocks down at this point of time.
Well, it does look like more of short covering, as CJ has been saying for the last couple of days. So CJ, this is your I said so moment.
It is. I think, but we should. I think we should be a little cautious.
Yeah, we still have four and a half hours.
These are just early trades. Let's get the market. Let's let the market settle down about 9:30. You will see the market settle down in the first 15 minutes, and then you can see whether this gain or this up move sustains or not. Clearly, I just feel that probably we'll be ending the session towards the green territory rather than in the red territory, but we'll have to wait and see how the trade manifests.
Well, the last stock on our watch list today is TVS Motors. Now, according to newspaper reports, the company is in talks with private equity funds to raise about $300 million in its EV arm. Now, CJ, the stock has been doing, I mean, clearly one of the star performers in not just the two-wheeler space, but also the auto space in general. It's almost at an all-time high right now at these levels. Now, clearly the play here is the electric vehicle part of it. A very strong market share here, close to about 19%. The company is spending close to 2.5% of its total sales on technology development, which is the highest in decades that the company has been spending. So at this point, yes, there are some chinks in the story, mainly the chip shortage, especially given that TVS Motors caters to the high-end premium segment. The chip shortage could really kind of be a break on the margins. But that said, I think the market appears to be very bullish at this point, and you can already see it in the prices.
Well, Santo, I think the bullishness, you cannot take that away, but I feel that optimism might be running ahead of itself. Two or three main issues. First, of course, is the rural demand side. Clearly, the weak start that we have seen to the monsoon this year, it makes me a little skeptical whether we'll see the sort of demand recovery or not in the rural economy. Remember that a good start to monsoon generally bodes much better than a late start to monsoon, because even if you have, your quota of rains in July and August and September, that doesn't really help the farmer who has to start sowing probably around end of May and early June, early parts of June. So clearly, sowing area has been low this year compared to last year. So I think that will remain one questionable thing going ahead for TVS Motor. Apart from that, as you mentioned, clearly the chip shortages are weighing on the performance in the 125cc and above segments for TVS Motors. Not only TVS Motor, in fact, even Bajaj Auto, probably a bit more for Bajaj Auto given that TVS has a more diversified product base. But even then, TVS is taking hit on volumes in these sort of segments, and therefore I think that will be something that the market should really watch out for. And overall, going ahead also, this chip shortage is not going to ease. In fact, things might get even worse, because let's remember yesterday news reports came out that Taiwan has raised electricity prices for the first time in many years, and this is expected to increase expenses for chip makers by at least 15 to 20%, and they are obviously going to pass it on to their customers, and that will probably be to the detriment of Indian automobile makers. So clearly, two or three things that make me a little skeptical that at the upside that the stock has seen so far, that will sustain going ahead.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. Thanks for watching, and please do share your feedback in the comment section below.
And as usual, follow us on the social media links at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and download the Money Control app. We'll catch you live again at 3 p.m. with all the day's action. Till then, please have a great trading session, as it looks like we are going to have today, Santo.